Welcome to the fourth video of the module devoted to the formulation of financial strategies. In this section, we will be dealing with the topic of risk management. To begin with, we will explain the rationale for a risk management policy in a company. Then, we will focus on the most important elements of an organizational risk management framework. We will end the video with a discussion of the different approaches to risk management, such as mitigation, diversification and hedging. As you will already know, risk management is among the key responsibilities of a financial manager in a company. As you can imagine, controlling and managing risk is a costly process, making it essential to understand the rationale for risk management. According to the theory of risk management, the role of corporate risk management is to assure that the risk factors to which a given business activity is exposed do not damage the business effort connected with this activity. To put it another way, risk management is all about maintaining the uncertainty at a level which is acceptable by an organization and its shareholders. As you know, risk and return are positively correlated, which means that investors generally require higher returns on more risky projects. However, after reaching a certain level of riskiness, the increased return does not counterbalance the probability of a project's failure. Thanks to a risk management system, an organization is in a position to select those investment opportunities which provide the level of return required by shareholders without taking on excessive risk. So, risk management may be considered a measure which supports the creation of a company's market value. From the point of view of relations between the shareholders and the management of a company, risk management is a tool which helps ensure that management are taking investment decisions that are in line with the expectations of shareholders. In theory, investors should be well diversified and should decide on investing in the shares of a particular company based on its risk profile and how those shares match their existing investment portfolio. Without an effective risk management system, management could be tempted to take decisions which maximize their own value rather than shareholder value. From this perspective, an organization's attitude to risk, commonly referred to as risk tolerance or risk appetite, is the instrument which provides the relevant linkage between the investment decisions of management and the requirements of shareholders. Let us take a closer look at the notion of risk appetite, which may be defined as the overall level of risk that an organization accepts in pursuit of its business goals. Although the definition is very simple, determining the exact appetite for risk is complex and difficult. Thus, risk appetite is often declared by companies as a statement of approach whose goal is to establish a common understanding of risk throughout the organization. It is essential that the maximum tolerated risk be defined and understood before any management decisions are taken in the area to which the risk is inherent. This relates in particular to making strategic investments, but may also pertain to day-to-day operations. As you will appreciate, risk appetite differs across industries and organizations. For example, companies whose activities may have an impact on public safety, such as nuclear power plants, are characterized by a low level of risk acceptance, whereas startup businesses typically manifest a high tolerance for risk. When defining its risk appetite, an organization has to consider the volatility of the industry in which it operates, seasonality of the business, and competitiveness of the market. The key dimensions of a risk policy are the target level of operating and financial leverage of the organization, as well as the degree to which the company will rely on forecasts and projections in its investment decisions. In order to properly address all material risk factors, an organization establishes a risk management framework which embraces the process of risk identification, assessment and monitoring, as well as strategies for dealing with risks identified. Please note that from the perspective of evaluating investment projects, risk assessment is largely dependent on the quality of estimates used to forecast the outcome of an investment. Accordingly, the risk framework in this area should put particular emphasis on the awareness of factors which could affect projections, as well as the quantification of their probability and impact. The risks related to forecasts in an investment project may be classified as strategic, tactical, and operational. Strategic risks are the ones that affect the overall direction of a project, such as macroeconomic and political changes, while tactical risks, such as changes in the supply chain or in the timing of payments, impact only a significant part of the project. Operational risks are the ones connected with the day-to-day management of the investment project, for example, the risk of breakdowns in equipment. A potential approach to the management of those risks can be based on designing appropriate measures to deal with risk factors, depending on the likelihood of occurrence and significance of impact. Please note that such an approach requires defining detailed criteria for the categorization of risk factors and their updating as work on the project progresses. The effective monitoring of risks is not possible without reliable information. Therefore, a company's information systems play a key role in the risk management process. The primary function of those systems is the collection of data on identified risk factors and on actions taken by managers at the appropriate level of the company's hierarchy. Systems also aggregate the data and make possible its presentation in different cross-sections. There are two types of information systems used by companies. The first is the Management Information System, referred to as MIS, which provides operational data, allowing a company to make decisions regarding identified risk factors and perform detailed risk analyses. The second type is the Executive Information System, referred to as EIS, which provides more high-level and summarized information regarding the key aspects of risk management to the senior executives in the organization. The internal audit function also plays a significant role in risk identification. Even though internal audit is not operationally involved in this process, the findings from audits and reviews conducted by the internal audit function may provide valuable information regarding the organization of a company's systems for risk identification and management. The final element of the corporate risk framework encompasses strategies put in place to deal with the risks already identified. In this respect, there are a number of approaches which companies may apply, ranging from the acceptance of the risk to its complete elimination. The strategies most frequently adopted include the mitigation, hedging, and diversification of risk. Let's briefly discuss them one by one. Risk mitigation is an approach to risk management in which the impact of risk factors is reduced as a result of implementing control procedures. The goal of a controls system is to prevent, detect, and correct potential risks before they materialize. As you can imagine, building and maintaining an extensive system of controls is expensive. Therefore, it is usually put in place to help a company defend from the most routine and frequently occurring risk factors. For non-routine risks, companies typically apply other approaches, such as hedging. Hedging is a strategy where a risk factor is neutralized by means of a transaction which creates an exposure to the same or similar risk as the hedged exposure. As you should already know, Hedging is typically applied to manage financial risks, such as currency risk and interest rate risk, with financial derivatives used as hedging instruments. Diversification means reducing the impact of a given risk factor by including and mixing a number of different investments in one portfolio. As a result of negative correlation between the investments selected, the overall risk exposure of the portfolio is lower than the sum of the risk exposures of the individual investments. The approach to risk management can be summarized in the so-called 4T framework, in which, depending on the level of likelihood of occurrence of a risk factor as well as the severity of its impact, a company can apply one of the 4Ts, namely tolerate, transfer, terminate, or treat the risk factors. For risk factors of low likelihood and low impact, a company may choose to simply tolerate the risk. If a risk factor is of low impact but its occurrence is highly probable, a company may decide to treat it by applying either a controls system or hedging against it. The way to deal with risk factors characterized by high impact and low likelihood is to transfer the risk to another entity, for example using insurance contracts or by passing the risk to counterparties. An example of transferring risk comes in the form of issuing invoices in the company's local currency, thanks to which the currency risk is passed on to the client. Finally, the only way of dealing with risks which have both high impact and a high probability of occurrence may be their termination. Here, termination means removing the source of the risk factor, which is the investment to which the factor is inherent. As you can see, a risk management system in a company is a complex structure encompassing a long process starting with the determination of the company's risk appetite, moving on to the formulation of a risk policy and the building of risk information and control systems, and ending with decisions regarding the treatment of identified risk factors. It should be remembered that risk management cannot be considered a static process. This is due to changes in the economic environment in which a company functions, where new risk factors may constantly emerge. Thus, a modern approach to risk management should be a dynamic process where risk policy is continuously adapted in response to altering economic conditions.